Hello, ladies and gentlemen, and welcome back. Well, in 2022, if you asked anybody out there that invests money, what is a good defensive sector, most of them would tell you utilities. That was until recently. In the last 4 weeks, we've seen something very worrying. Utilities, the defensive sector, the one that has basically held up the market along with energy and other areas, has now crashed. Negative 20%. In only a few weeks. What does this mean for markets moving forward? Well, we've got the stats in today's video and some worrying trends that tend to occur. Yes, it usually means that some kind of watershed moment is coming for stocks, or at least we're approaching those low periods. We're approaching a period of potential fear coming back in. Whether that happens right now or it happens in a few weeks, it is a stat that we want to be looking at. And on top of that, of course, we've got the key levels that we should be watching in markets right now, along with the macro data. So it's earnings week, we've got inflation reads, and we have the FOMC. There's so much to discuss. See you soon. Well, welcome back everybody to the Daily Show. Let's begin by discussing utilities because, of course, when we're looking under the hood of stock markets, we want to look at the sectors. We've got great tools that we'll be showing later on today's video that can help you to really show how the money flow is going through this system. So when we see the utility sector crash, we can start to build some percentages. In fact, once the S&P 500 utility sector has declined over 15% in the last 21 sessions, we get some very interesting reads. Now notice that we generally get reads like this near potential watershed or maximum fear kind of components. If you actually look at the stats for the S&P 500 after we've had these 15% declines, it's not pretty. In fact, it's less than a coin flip in a 59% of the time bullish market. Remember that. That's the stat over 100 years of data that we are up over a 1, 2, 1 month and multiple month kind of periods. So what does this mean? Well, it tells us that what was once safe is now becoming potentially toxic in markets. And we've had so many big changes in 2022 that are starting to really bring us to this idea that if we get another bad inflation read, we could tank in these next couple of days, even next couple of weeks. We've got first time in decades that certain history is occurring. In fact, this is the first time that since 1938 that we've seen the third quarter go down in the history books. It's the first quarter since 1938 that the S&P 500 index has closed in the red after gaining more than 10%. Here's the thing. Usually you get some kind of thrust or breadth indicators that push you out of one of these massive kind of crash periods. We saw that only a few months ago. We've now seen it last week. And they tend to run and not necessarily drop back. So 2022 is very tricky because we've seen new historical records, kind of like any bear market, but some of the things that have worked in the past tend not to be working right now. If we think about average bear markets and bull markets, you can see here that the average bear market going back to the peak lasts 446 days. You know, you would know by now that we're only at the beginning of that kind of halfway area in terms of the average bear market. The average bull market and bear market, of course, 209%, and bear market technically negative 38%. And we've got some stats later that you can show and have a look at the average bear market. So could we see more pain to come? Well, we're not near those percentages just yet. We're not seeing negative 30s in those bigger bear market kind of situations. So while we're looking negative here at utilities over maybe the medium term, let's take a look now at the S&P 500 over the short term, because we've just had a very strong couple of big statistics. We had 100% bid on the NASDAQ last Tuesday, where all 100 stocks were up, a very rare reading, only happened 6 times since 1996, tended to be relatively bullish after the first week. Here's another stat. 5-to-1 back-to-back days. That is 5 up issues versus down issues on the New York Stock Exchange. A horrible 1 week, which was last week, but some positive kind of data moving forward through the next subsequent weeks. The same thing with volume thrusts. We've had the last week being pretty bad, which it was. And then we have some very positive. In fact, 100% of the time after a reading such as what we saw positivity in the next week. You'd have to hope that that means the FOMC meeting minutes, inflation, and the bank reports aren't as bad as some people believe. Smart money versus dumb money. Again, we've just talked about the massive difference between these two levels. We've had these before, and when we've had these kind of big differences, we've often been at those lows, or at least temporary lows, in 2022. Here's some statistics. Again, we got the reading for last week. Not so positive. It wasn't a good week, but the subsequent couple of weeks here were positive. So does this play into the game, into the story that we've got right now? Well, of course, seasonality would make you think that during midterm election years, which it is, we would be going up. Also, if we're looking at bear markets, here are the last 200 years of data if you're interested. And this is probably the chart that most people are looking at right now, just in terms of synergies, where we see that kind of bear market pull up and then potentially the watershed moment afterwards. Now, utilities is pointing towards this being a very real occurrence, very real possibility. I think it's going to need a catalyst. That catalyst will most likely come from the Fed or from a bad data point such as inflation. This is where the synergy with 2008 becomes really extreme. In the next subsequent kind of month to 2 months, we should know whether we're actually correlating incredibly heavily with that market. And a lot of you out there have been commenting, oh, here we go, 2008 synergies. Yeah, look, it's just an interesting point. This is literally 90% plus correlated with that time. And we've got utilities doing a very similar thing to what was happening in 2008. The similarities are uncanny. Sovereign crises, all sorts of weird liquidity issues within, of course, the pension funds. You've also got in the Bank of England. And then, of course, you've also got Credit Suisse and the Deutsche Bank situation, along with some other banks. So speaking of banking, we start earnings week this week. Now, it only starts with some small companies, but by Friday, we're going to know a lot about potentially the US banking system. Morgan Stanley, Citi, JP Morgan, Wells Fargo, they're all coming out with their reports. And this begins and kicks off another earnings season. Historically, markets have generally bulled into earnings seasons. They tend to be optimistic into these events. So again, if we're looking at the stats, that would point towards this week being bullish potentially. Again, I would just say it's all about the inflation number. Thursday, guys. You've got to have that in your calendar. Be very careful there. That's when we're going to see most likely the most amount of volatility in this market. So just before we jump into the charts and take a look at the key levels we should be watching, I wanted to say a big thank you to the sponsor of today's video, which is Tiger Brokers. And this is one of the features I love about their platform. Whether you're from the Australian market, whether you're from the American market, or in fact, Singapore, Hong Kong, or many other markets they offer, check out this. This is the market capitalization over the last 10 days. And what it shows you is rotation. Today, we're talking about utilities in this video. And specifically, you can see here that utilities has been one of the worst performing sectors over the last 10 days. But notice automobile manufacturers. Now, if you go through the last 5 days, you'll notice automobiles have done -6, utilities have done -6.62. Way worse than actually semiconductors throughout that period. And if we look at the last 24 hours, you'll notice that it's kind of changed up. And then all of a sudden, semis did most of the damage in the last 24 hours. But for a while there, automobiles have been the short in the markets, and they've been doing it for multiple days. Once you start to get on a trend, that rotation tends to occur for quite a few sessions. So it may be worthwhile having a program like Tiger Brokers to allow you to see this rotational switch. You can also jump into the industry tab that they have here, do a percentage change for 5 days, 20 days, year to date, whatever you want to do. And you'll see here that the worst over the last 20 days have been heavy electrical, aluminum or aluminium as we call it here in Australia, healthcare, REITs, tires, rubber, all of these types of things. So some of these sectors have been pretty bad. You can click on one of the stocks. If you don't know what tire, rubber stocks there are, here's a Goodyear, that's the one. If you don't know what footwear stocks there are, there's some of the ones. It's a great platform for being able to do this. Then you can dive in on the stocks themselves. And of course, do remember that there's a whole bunch of other features here, including news reports, including premium news. You've got a calendar report for the earnings season, and it's all there on the Tiger Brokers platform. If you haven't already subscribed and you're from, of course, Australia or New Zealand, remember we do have a special offer for you guys. 40 free zip stock when you fund with 1 cent or over. Look at the description links down below. And of course, you'll be able to potentially open an account there. For everybody else, there's some other links down below with some special offers. Thanks so much, guys. We'll see you in the next one. Bye for now. So What other bullish cases could you make? Well, of course, S&P 500 stocks above the 200 moving average is back down on our blue line. This has just historically been a good level for some investors to come in and say, well, maybe we're hitting those kind of extreme lows in terms of the market. It was good back in June. Will it be good right now? Well, time will tell, of course. During the watershed moment of 2008, it fell straight through and then stayed even lower for longer. So, of course, if we get that similarity, that was the only other time in the recorded history we can see there that we had problems. The VIX ended up 3.54% for the Monday session. It was up more before we kind of recovered off the lows. We did fill some gaps. We did some kind of positive things on the stock market, even though it wouldn't have looked like it for the day. And we've got those key levels coming up later on today's video. Let's take a look here at the VIX. As we can see, there's no 35 plus, so we're not in max fear at this stage, but we're getting damn close. 32.46, still a very elevated VIX ahead of the inflation number. Yields also ahead of the inflation number remain super high. You look here at the US 10-year, we're sitting at almost 4% again. If it spikes higher, what does that usually mean for the stock market? Down. And I do believe that this week, which usually you wouldn't say, the data really does matter. If inflation has dropped, you could see serious big moves here on these yields. Take a look here at the US 2-year, 4.3%. Obviously, right up at that peak, awaiting the FOMC meeting minutes, awaiting the inflation numbers. What about bonds? Well, bonds are traditionally not liking themselves right now. Of course, we've got corp grade bonds back on the lows again, testing those lows, decent volume coming through. And it's the same with high yield as well. So if we go to like HYG, we can see here that high yield corp bonds also testing those lows. Now, if these go through and make new lows and the stock market doesn't, it has been a precursor that the stock market's coming with it later. Remember, we've used high yield, especially this year, to precursor that the stock market was going to make a new low. And that is what happened. So it's kind of a good lead indicator here to look at the bonds and watch them on the charts. What about the US dollar? Well, it's in a precarious situation as well. Things are still very bullish here on US dollars. And at this stage, you would think the bullishness should remain at least until that 113.63. Now you'll notice I boxed two zones. The first time frame change of trend could occur if we break underneath this little level here, and that price is around 112.85. So basically, if we get some weakness here, then we might see a little bit of a pump and probably a turnaround to potentially push back down into the structure that we formed around that 112.20 area. This is going to be a new important 24 hours. I would expect the dollar index though to remain elevated into the inflation number, into the FMC. These bits of news will probably move things around quite a lot. Gold's returning back. Anyone that got the sell up here around these levels, congratulations, you did very, very well. If you didn't take all your profit here and you've left it on, we're getting close to that secondary structure zone. We're basically in it now. And you'll notice I've highlighted what I would call the cheap demand area in this market. 1660 is a very important level. I've got a little alert just sitting there. And what I'd like to see is I'd like to see the market tap that zone, break out above maybe where it is right now, and then a little pullback towards bullish pressure. Now, this is where if the bulls are going to demand gold, they're going to come back in here, and you would hope that it synergizes well with DXY going into that supply, then selling off, at the same time gold punishing these lows, and then buying up. And the switch, remember, they should be synergized very closely together, just like the euro US dollar if you're a currency trader. What about oil? Well, oil showed the first signs of weakness here. We've had amazing strength coming out of oil. We're on only a 1 hour chart here, but I wanted to just show you the change here that's happened. We've got a new higher peak that's formed. We've broken through what was a pretty decent little demand zone, and now we're returning back to it. You would believe that somewhere between that 92 and kind of 92.50, we should start to see some weakness back in oil. And at this stage, I'd be going with the negative side from a technical level. The technicals are showing the first time frame changes of trend, and that could push us back down to relatively significant levels down here, back into something like an 88.26 or even an 87. The sell signs are there from the smaller time frames, and does it work out to be at a very good higher time frame level? Not really. I think most people, the way they're going to look at this is they're just going to draw the trend line through these highs and say, okay, well, we got close enough to that. That's the kind of level that I believe there should be selling at. At this stage, recovery, and then a potential short off back into these previous resistance highs and back into that demand zone that sits behind. So it looks like oil could be weak for now after what was a crazy OPEC event where, of course, the cartel got out and they said, no more, we're going to slow the production, ruining our case for, inflation really dropping. Of course, when they start to constrict the barrels, well, that's a problem for the US economy and, in fact, the worldwide economy. What's happened here on Tesla? So it started to structure up over the last 24 hours. We were doing this one live on our Monday streams, and we saw here, of course, A, which was the difference of this double top, become B, and the market slammed straight back into that 220 level that we've been discussing. It actually got to 218, and by the end of the session, we actually saw some buyers coming back in for Tesla. Now, it looks pretty certain at this stage that Elon will probably take over Twitter. Of course, that's the story that's holding it down. How much does he have to sell? All sorts of speculation about that Twitter deal. That's what's really keeping this one quite weak. But you'll notice technicals has pushed it through, and now we enter the demand zone. So over the next couple of days into the inflation numbers, we hope to see some form of structure. We've seen some buyers come back in. They've shown commitment. We've got a lot of gaps left behind on Tesla, some higher as well. And at this stage, you would think it's more of a demand market than it is a bear market around these levels. Nvidia is another one that just fell through. Semiconductors had a horrible, horrible day. As we saw when we were looking at the Tiger Brokers platform, semiconductors have been weak now for sessions. But what happened was a really good little intraday trade. We saw the take of the previous low. So this was the 2021 lows. We saw that get hit, it got taken, and then we saw little rebounds by the end of the session. It kind of makes me believe that there are quite a few stocks hitting into demand zones, and we could have a nice little 24 hours here on the stock markets. A lot of things hitting extreme lows and rebounding off those extreme lows. That's a relatively positive sign. Let's have a look at Amazon. Similar thing. We saw it hit into its previous wicks and find some buyers by the end of the day. Of course, you hope that carries through to the next session. And if it does, when we look at the S&P 500 analysis very soon, that could bode at least semi-positively leading up until the FOMC meeting minutes and the inflation data. Let's have a look at utilities. So you can see here the big drop off. And the reason why I wanted to bring up utilities is just to show people that it's worth doing some cross correlation. So if we load on the S&P 500, if you're not sure what platform this is, it's TradingView. You can click the link in the description down below as well. And if you want to sign up, you can do it through our affiliate link if you're interested. But basically over here, we can see the comparison that we've done. Now, if you go back and look at other previous times where the markets have been suffering, especially through this 2008 period and the previous 2001 period, what you might notice is that the stock market is weakening, yet we see utilities strong in comparison. So strong in comparison. Then all of a sudden, utilities breaks through the key support. Look what happened afterwards in 2008. We saw that watershed moment. Everything was getting sold. The utility sector, the healthcare sector, all these defensive areas, XLP, the defensive consumer staples, were all getting sold off. So utilities kind of front-runned it. And what I mean by front-runned it is we saw the sell-off here in the stock market, which was actually being sold off afterwards by the utilities here. And then the utilities kept falling. And then all of a sudden you can see, if we synergize this, utilities broke through that support, similar to what we've seen recently. Then we had the watershed moment, which basically created that huge sell-off where everyone went super negative on the markets. It started to then structure up, made one last low to really trash everybody. That was a full-on capitulation. It was out. So this is one of those fear things that could be just around the corner based on what's happening in the utility sector. If you look at it here, we've of course got the stock market doing horribly, no doubt. Utilities has been rallying each time, finding those buyers, and then all of a sudden now it's gone, yeah, I'm not too sure about that, and it's fallen through. So we're at that pivotal area here. A change is needed for the stocks very, very soon to hold it up. Let's have a look at some of the markets that are holding barely. We've got literally the FTSE kind of like a proxy to utilities and energy. It's bounced off that big demand zone. Of course, it falls through here. We have an alert that's sitting underneath the 6,800. If that breaks, watch out down below. It could be critical times here for markets around the world. Let's now have a look at the NASDAQ. How's it faring? A new low formed over the last 24 hours, but some okay positive signs. And what I mean by that is it's filled the gap that was underneath. We now have a gap that's above. So we have one that was left from the non-farms event, and we have a little supply area that sits around that 11,100. Now, if the market's able to breach that zone, you would think that's positive towards pushing back to potential gap fills and back to all of these imbalance or inefficiencies, as people would call them, along this huge sell-off that happened on the Friday after the non-farm payrolls. Will it require the FOMC or some kind of event catalyst like inflation? Well, that's the problem people are going to have. It might just ramp, sit there, wait for the FOMC on the inflation number, then break through, and then we can be more sure that the market wants to move to the next level of equilibrium, which should hopefully hold up around that 11,488. An exciting time on the market, but we've got to be super careful. You know, this low from the previous session should hopefully hold. Again, we want to see breaks of these highs. Let's move through some other markets now. We'll go over here to the US 500. We'll actually start with just the S&P, as in the real market here. You can see that it didn't quite close the gap, but we have a lot of closures here. We've got like monthly closures, weekly closures, all sorts of things. We have an unfilled gap up at this level. It's time. This market really needs to find buyers pretty damn fast. It's a critical ahead of the big news. Volume is relatively pretty hot. You've got that island reversal. You could go very much either way here. I wouldn't blame a bull or a bear for having a strong case. Sometimes you get it where it's very much like this. For the bulls though, you're looking for getting past that 3660. You want to see a 3660 plus bullish move, then hopefully pullbacks met by bullish demand to move into, again, the unfilled gap that was left from non-farm payroll. So bull case is looking up there. You've got your thrust, you've got your bids, you've got your breadth, you've got all these reasons to feel bullish about the market. You're feeling good, but you haven't seen it just yet. For the bears, well, you guys know what you want. A new low, and more importantly, a horrible, horrible inflation read. A read that is well above expectations, or the FOMC saying something wild. I highly doubt they would. Or of course, by the end of the week, potentially the banks telling us something that we don't want to know about this economy. Again, fear is high. People are feeling very fearful. Do remember that when you're checking out these markets. What about Bitcoin? Is it leading? Is it telling us anything? Well, Bitcoin's just on its previous higher lows here. Actually, it's been holding very, very well. I mean, no one's interested in it anymore. Maybe some of you in the chat are. Let me know in the comments down below. But these levels here are super pivotal. 20,400, we didn't quite breach what we needed to see the buyers fully commit to this trade. They didn't, and now we're pressuring back down. Remember, if stock markets make new lows, if we get a bad inflation read, don't think that Bitcoin's going to be safe in that, guys. We're going to possibly pressure back on that 18,000, on the 17.5. And I've said this before, during Bitcoin winters, 83 to 86% down declines. That puts us between 11,500 and 9,500. That is the level that I would have to expect Bitcoin to move to at some point over, and realistically before, hopefully around February of 2023. If the bear cases are going to work like they have in the past, we should see further decline. Is it going to be now though? Well, set the alerts, be very, very careful down there. If you haven't already, come and follow us over at FX Evolution on Twitter, and do remember the big news coming out Wednesday, October 12th. We've got 8:30 a.m. the PPI. Then we have the FOMC meeting minutes at 2 p.m. New York time. And then we have the big one, core inflation here, CPI readings, 8.1%. It's expected to drop. Will it drop more? It needs to push those bulls through. And then on Friday, we also have core retail sales and retail sales, prelim UOM sentiment, and the big banks reports. So it's a week that is jam-packed near the end. There's going to be a lot of risk out there. Remember, if you're not comfortable, just don't get involved. Always remember there's another week. There's another potential setup. For some people right now, potentially currencies, gold, they may hold the better trades than possibly even stock with all of the things that are at stake right now. Thanks so much as well to Tiger Brokers for sponsoring today's video. Remember, if you're interested in claiming those extra zip shares, 40 zip shares now special for FX Evolution community members from Australia and I believe New Zealand. You can check out the links in the description. Thanks so much for watching. Subscribe, smash the like button. We'll see you in the next one.